Good morning. My name is Frank Grinnell. I've been advising professional money managers and investing in the stock market for over 20 years. It serves as my day job, but most importantly, it is my absolute passion. On Street Views, I offer my daily viewpoint on the stock market in under 7 minutes. I will cover things like the global macroeconomic picture, the mood of the market, company-specific news, secular trends with some actionable sector and stock calls. I hope my insights are useful to you, whether you are a professional money manager or a passionate investor. At Grinnell Capital, we actively manage dynamic stock and ETF models for financial professionals and their clients, as well as individual investors. If you want to learn more about what we do, send me a note, frank@grinnellcapital.com. You can also find more of my insights on Twitter @GrinnellFrank. And now, today's Street Views.
Hey, good morning. Not Monday, Tuesday, 6th of September, 2022. Hope your fantasy leagues are all set up. Hope you had a good Labor Day weekend. We're, of course, looking forward to the start of football. Fun to watch college games over the weekend. Equity futures green this morning after Friday's sort of sad, pathetic sell-off on a really low-volume day. About a little more than 50 bips across the board. Russell being the weakest of the lot. Crude oil flat. Nat gas down 3.5%, I think down almost 4.5% now, breaking down below 850. Wheat and corn a bit green. Energy's been acting pretty heavy. There's been a lot of thought about OPEC Plus defending this kind of $85 WTI price. We'll see what happens. It is flat. They did cut production a touch over the weekend, so it looks like an earnest effort to defend this $85 range. See if that happens. And again, we've talked about this the past couple of days. Our technical work does show that there should be a bounce coming just in the near term. 3,900 is an important level on that S&P 500. You've heard that before. I see the same thing. To the upside, look for 4,000 to be resistance for the S&P. That's where the 50-day moving average is. You can pull that up and see if we get a confident surge over that, that would be pretty constructive. Coming out of August, we are working on our update for the month of August, and to get that out to folks pretty soon once that gets through compliance. We did go through the exercise of taking a look at recession risk to the S&P 500 in terms of EPS and what that does to multiple and what that does to the S&P 500, sort of level itself. The average earnings decline to the S&P 500 is 26%, peak to trough. EPS in a recession. That takes a look at 1990, 2000, 2020, leaves out the 57% decline we saw in 07, 09. The exercise for us was to kind of take a look at an average garden variety recession and just kind of extrapolate what that would look like for these markets. The global financial crisis was a little bit above average in terms of recessions. So when our starting point is $215 in earnings for the S&P for 22. That's versus 225 Wall Street consensus. Eddie Ardeni's got 215 out there. I'm going to use his number. He's usually a pretty optimistic guy. So if he's at 215, obviously seeing a little bit weaker Q3 and Q4 than consensus, I'm all in on that. So 26% pullback from 215 gives you 159 in EPS. Average multiple on trough earnings during recessions has been 18.5 times. It is lower during times of inflation, so kind of if rates do keep on escalating, you can assume that multiple is going to be lower. But for now, we'll stick with that 18.5 times. That gives you a 3,000, S&P at 3,000, just a little bit below that in terms of pure numbers, but 3,000 is good enough for rounding. And you've heard this from others. I think Dan Niles has been pretty vocal about S&P going to 3,000. That's what it shows doing this simple exercise that we did. So that's something out there to be aware of it. It's not a prediction from here necessarily, but it is. It wouldn't be. I don't think it'd be a total surprise, just given what it feels like is happening out there. You've had obviously a pullback in fundamentals, decreased demand. The enterprise looks like they're getting a little cautious. Comments out of Benioff, comments out of Okta CEO. Lulu's doing great, but everybody else looks like they're having a little bit of a tough time. In terms of new money, We still like it defensively. We talked about this, whether it's large pharma. Med device still holding in there on the IHI. We did pick up some Archer Daniels Midland ADM last week. That ag trade looks constructive. We also own Deere. We also own Mosaic. Mosaic just really strong cash flows and a cheap stock, and a disrupted business given what's going on with Russia. High cash flows, low multiples. You guys know the drill. Defensive business models, or really defensive sectors themselves. I think it's too early to start going cyclical. And that's it. Have an awesome Tuesday, and have a great week.
And now for some important disclosures. Grinnell Capital is a state-registered investment advisor. Services offered by Grinnell Capital can only be offered in certain states where Grinnell Capital is registered or meets required exemptions. Registration does not imply a certain level of skill or training. For additional information about Grinnell Capital, including its services and fees, please review the firm's disclosure statement as set forth on Form ADV and available at no charge at advisorinfo.sec.gov. This podcast is provided for informational purposes only. The information contained herein should not be construed at the provision of personalized advice and is subject to change without notice. This material should not be considered as a solicitation to buy or sell any asset or engage in a particular investment strategy. Investing in securities involves the risk of loss, including loss of principal invested, and may not be suitable for all investors. Past performance is no guarantee of future results. This podcast contains certain forward-looking statements which indicate future possibilities. Actual results may differ materially from the expectations portrayed in such forward-looking statements. As such, there is no guarantee that any views and opinions expressed will come to pass. All expressions of opinion reflect the judgment of Grinnell Capital as of the date of publication and are subject to change without prior notice. This podcast contains information derived from third-party sources. Although we believe these sources to be reliable, we make no representations as to the accuracy of any information prepared by any unaffiliated third party incorporated herein and take no responsibility therefore. This podcast is provided with the understanding that Grinnell Capital is not engaging in rendering legal, accounting, or tax services, and we recommend that you seek out the services of professionals in these aforementioned areas. The principal investment focus of the accelerator model, the strategy, is to achieve strong relative and risk-adjusted returns, primarily by investing and trading in securities issued by companies that focus on the global information, technology, consumer, healthcare, industrial, and infrastructure sectors. These sectors are characterized by robust secular growth, an abundance of both new and maturing product cycles, a high degree of competition that creates the potential for relative winners and losers within a subsector or theme, a high degree of revenues and earnings volatility, rapidly changing sentiment and public perception, significant yet unrealized potential for globalization, and superior relative liquidity. Investment in the strategy is speculative and involves a high degree of risk. The second investment model is called the ignition model. The ignition model is an all-exchange-traded fund, ETF, strategy with an investment objective similar to the accelerator model. This model seeks to capitalize on long-term growth trends experienced by the market leaders in various areas and sectors. The ignition model will also seek ETF investments based on cyclical forces experienced in the U.S. and the global economy. This model is also designed to have the ability to offer some downside protection in the event of significant market stress through investments in ETFs designed to take advantage of market volatility. The strategy's performance can be volatile. Grinnell Capital has total trading authority over the strategy. The use of a single manager applying similar trading programs can mean a lack of diversification and consequently higher risk. For more important disclaimers, please visit our website, grinnellcapital.com.